Tesla, the electric car company listed in the US, surprised the market recently at their third quarter results. Their China factory is well on the way to production, and they reaffirmed their expectations for growth and profitability next year. The stock rose quite sharply, and we thought we should have a look. We rapidly realised there was so much to cover that there was enough to make a short video for each of our governance, accounting and peer performance metrics. As usual, before we go on, I must remind you that under the Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. On to their performance. Tesla's past is impressive. Since 2014, revenue is up 5 times, and they now dominate EV car sales in most countries apart from China. They've also forced the major car companies and governments to change their strategy as to electric cars. The problem is, it is this very success that is undermining their future. In 2020, the European car companies will flood the market with EVs in a desperate attempt to avoid multi-million-dollar fines for carbon emissions. Tesla will suffer because it will be cheaper for the European car companies to subsidise and lose money selling electric cars than paying fines. North America is a different story, but it seems that Tesla may have maxed out the demand for premium value sedans because sales in the US are already dropping. This leaves China as the great hope for growth, which is presumably why Tesla has worked so hard to get Gigafactory 2 operational. The good news is that the factory had lower capex. Presumably labour costs will be cheaper and it will avoid import tariffs on the cars. So most are assuming they'll be far more profitable. However, as any Hong Kong property developer will tell you, foreigners always pay more in China than the locals. And so Tesla will never be able to match local production costs, and given that there's plenty of local competition, there will always be cheaper cars available to consumers, and many of these are quietly backed by the local government. We expect that the Mark III, like elsewhere in the world, will remain a premium car in China and wonder if, like in the US and Europe, after an initial sales surge, demand will taper off. As a side note, overall car sales are already slowing in China, and EV growth has also been lower than people expected. As such, the market may just in general be somewhat tougher than people are assuming. This is a problem because although Tesla's margins are similar to other car companies, it's on far, far higher multiples. We can only assume that our investors are expecting rapid growth, and if Tesla fails to deliver, we expect the market to react aggressively. Some believe Tesla is worth paying a premium because it has a data advantage, and while we agree that 3 years ago this probably was the case, today you can put sensors on a petrol car, and even if the large petrol companies only started collecting data today, their scale means that within 6 months they would have far more data than Tesla's collected in its whole lifetime. Finally, there's the debate about autonomous driving. Now, we don't know who will have the advantage, but there are plenty of competing systems, and we do know that even if the big companies waste 50 to 75% of their R&D budgets, their spending will still be much, much higher than Tesla's. We think the odds aren't favourable. Ultimately, Tesla has done very well to get this far, but the big companies have finally woken up. We don't think all of them will survive, but the Chinese and European governments will not subsidise an American company that then uses those subsidies to put their own companies out of business. We think the potential for a demand cliff and continued losses is much, much higher than the market believes. If you want to get some more information on some of the issues we've covered, or some background information, please visit our website using the link below, where we've highlighted some of the key points in their most recent filings. If you'd like to know more about our research, please visit our website again or send us an email. Alternatively, to keep up to date with our reviews, subscribe to the channel. Thank you very much for your time.